It's my great pleasure to introduce Bill Burnett from Homestead Mortgage. He's here with us today to answer some interesting questions regarding about the mortgage process. Bill has been in the business for about 30 years and he's got a lot of experience. What else are you connected with?
I'm the president of the Virginia Association of Mortgage Brokers, and I've been the president for about 8 years now. And I probably have that job till I don't want it anymore. I'm doing a good job growing membership, so that's a statewide level. Obviously been on national television, nationally recognized in my industry on ABC, CBS, Fox, and all the major networks in prime time. That and just the experience of being around.
Absolutely, and of course you and I have worked together in the past.
Absolutely.
So this actually should be really kind of pretty standard for you. That's great.
As long as it's not an exam, I don't get questions.
No, it's not an exam. Don't worry.
Okay.
These are just some basic questions that we put together that we thought, buyers and even sellers, because sellers become buyers at some point, would benefit from. So they're just some basic questions to just differentiate things. So what's the difference between a lender, say a bank, for example, and a mortgage broker, would you say?
That's actually a great question. That comes up a lot. So a bank, and this is generally, a bank typically has a line of products that they have to offer with certain guidelines and a rate that day. And typically, you either fit in that box or you don't. If you don't, then you can't do a transaction with that particular institution. Generally, you're going to find that the generic loans, the standard vanilla pieces they're going to have for you, they may or may not be aggressively priced that day on rate. On a broker, on the other hand, has typically relationships, maybe up to 30 different lenders, okay? And they can be non-banking institutions that just do mortgages, but they're very, very large. And so, I have, for example, a place that will do 1 day out of bankruptcy. A bank would laugh at you if you said that.
A bankruptcy?
Yes, 1 day out of bankruptcy.
1 day out of bankruptcy.
Or short sale, yeah.
Wow, okay.
So brokers tend to be quick on their feet too as well, so the changes, regulatory changes, brokers tend to adapt to those a little quicker than a bank, which is a larger institution that has to deal with a lot of the bureaucracy issues. So brokers typically don't have to deal with that.
Okay. So we've got the lender versus a broker who can go to several different lenders as opposed to just the lender who really just, it's about their product.
Right.
So given all of that, what would you say the advantages to working with a mortgage broker are over a bank?
Well, I'm able to again, come back to the what is your criteria for being approved for a loan? The credit score could be low. Income could be an issue, so debt-to-income ratios, different things that might be hindrances at several different lenders, but to be able to go to that one lender that's going to say, okay, we have a box for that, we're going to be at market rate, we just happen to have guidelines that were more adapted to that particular situation. I mean, that's an awesome thing to have. Typically also, I have 30 people look at their rates every day. So lenders and people don't know this, but rates change all during the day for everybody, because the money kind of generally comes from the same place. But certain lenders will price a little more aggressively to cut their profit margins a little bit to be priced better. So I should be able to look as a broker each day at who's got the best rate out there. So it's a big benefit.
That's a big benefit, absolutely. Why is it advantageous for a buyer to use a lender who's in state?
Well, I'm not saying somebody from out of state can't do a transaction, because that they certainly can. But typically you are on regulatory, different states have different regulatory issues. If you're from California, for example, you might not be familiar with some of the Virginia-specific regulatory issues, which can cause a problem both for the buyer or seller or for the institution doing the lending, California. I think it's even more than that. I think it's more local. So it's not even really state, it's more local, because if your lender is very familiar with geographic issues of where the property is located, certain issues that might be related to that property because you've been working and doing transactions in that area. Certain questions from a buyer that might say, hey, what's going on in that area over there versus this area over here? Obviously the realtor should be able to push, but to have a lender to be on board as a team member, to be able to actually back up whatever the realtor may be saying, or to give additional information. For example, I've lived in this area for over 60 years. Mm-hmm. I know the area pretty well. So I think it's more local than statewide is a benefit.
Okay. All right. And what about as the transaction's going through, and the day of settlement, is it advantageous to have somebody who's local as opposed to somebody who's out of state when you're coming down to the wire literally?
In my opinion, yes. I will say this, short of being on a deathbed, I've only been so sick once in my career that I haven't attended my closings. And so handling the transaction all through the process, making sure all the questions are answered, make sure things run smoothly, that's very critical and important. And so people can do that, but things do happen occasionally, very rarely, but they can happen at settlement. Then you have to chase down your lender, who might be on the golf course or someplace where they can't be reached, or they might not want to be reached because they know there's an issue, okay? If I'm there, all right, and in the rare instance, something comes up, where's that $500 fee, what is that? And nobody recognizes that fee, I step out of the settlement, I call the lender while the settlement continues on, I get everything corrected, new instructions, everything's sent back down, and we're corrected, and we're done. There's no sitting back out in the office for several hours and trying to wait till your next turn, settlement, to get very busy. So, I think that's a big deal.
Yeah. So buyers need to be aware that it really isn't just about the rate. Of course, the rate is important because everybody doesn't want to spend more than they have to. But also the, having somebody who's in state and even better, someone who's local, as Bill has said, really can help with getting the transaction through. And sometimes things can go wrong, and they tend to go wrong if they are going to at the very last minute. And so that the buyer's not in default in any way, it's really very useful to have somebody on hand. So there are definite advantages to using someone who's local and knows the area. What would you say to buyers then who are wanting to use online lenders with whom they have no prior relationship? This is somewhat related to the first question. But online buyers where the rates are very appealing, any tips there, anything to be aware of?
Well, I'll tell you what I'm hearing from the field, from the real estate side of the equation, and then there's some things that I'm aware of as well. But typically, again, a loan is a loan. Taking a loan application is not too tough. You can train pretty much anybody to do that. The problem is from that point, what loan product do they go into? Where are they going to go? How's it handled in underwriting? Answering any questions. Typically what you find is the folks that are online are working on very thin margins. How do they do that? The reason they do that in most cases is a lot of them have call centers. So when you're working with somebody, you're working with, I guess, somebody that might be potentially have the title loan officer, but they're just a call center. So when you call in, you're getting somebody that can fill out the paperwork, but that's about the limit of the knowledge. And that, as you are very aware, that could be a big stumbling block and a problem to the process. And then, when you call back, it's potentially, you might be speaking to a different person because it's a call center type thing. That person then hands the paperwork off to the underwriter and it's in a black hole and they have no idea what's going on. Right. So typically you're going to find that what I hear from most realtors is when they hear the word, it's an online lender, they immediately get the panic feeling.
We do panic. We do. Exactly. Because we understand how important a lender is. Right. As I mentioned previously, I see the transaction as the patient on the operating table, and the patient is the transaction. And the players around the table are the title attorney, the lender, the agents, and of course the seller and the buyer. And all of those people have to be interacting on a regular basis, and the communication has to be open and absolutely. Often frequent for things to go well.
Absolutely.
So online, be careful because clearly you might very well be getting somebody who's just getting the information rather than somebody who's the same as a loan officer. And if they're not asking the right questions at the right time, you may find later on that there's something that you didn't qualify for that you thought you might have. So again, be very careful who you work with. How early on in the home buying process should a buyer ideally contact a mortgage broker or a lender?
Well, that's a great question. I get asked that a lot. And the answer I usually give out is 6 months. People go 6 months.
6 months.
Well, and the reason for that is a lot of folks, unbeknownst to them, have a credit issue. Okay, that's not aware. They're not aware because they haven't applied for a credit card or an auto loan or something for a mortgage for a long time. That's causing their credit score to be low. Right, still doable, but if they were aware of that, had a couple of months or some time frame to correct those things, which most things are not too tough to fix. I do that on a regular basis, and I mean 40, 50 points in like a 2-month window, okay? That is gonna help them on their interest rate, it's gonna help them on their buying power and everything else they're doing as well, okay? So a lot of times it's good to be way out in front of it like that, and then any issues that might be their challenges are addressed at that point. If there are no issues, hey, great, we're good to go. We go through the pre-approval process and we're twiddling our thumbs till it's time to, actually start the process of looking for a home. But if not, we can have time to correct those challenges and put them in the best position possible.
That's interesting because 6 months is longer than I would have thought, but I hear what you're saying, especially if somebody hasn't tapped their credit for a very long time and they really have no idea that something might be going on, and of course you need the time to be able to put things right. So there are lots of parallels between the lending process and the buying process as well, because typically we will say to sellers, don't contact us a month before you want to go on the market. Sometimes people contact you a week beforehand, because there's so much that can be done to make the house, to prepare the house. There's just so much going on that the more lead time that we have, the better product we can actually come up with.
Well, the part on, for example, the credit side that's often a challenge is you're dealing with a couple things. You're dealing with correcting the things that are challenges, okay? But then when you correct those things, it can take 30 to 60 days afterwards to actually get onto your credit report and get a score reaction to it.
That's right.
So there you can go from 3 months to 6 months pretty quickly.
So it takes a long time, but you take the action, but it doesn't register, it doesn't show up until sometime later.
Correct.
Absolutely. Correct. So that's a very good point. How much can a lender actually do before the buyer makes an offer and has it signed by the seller? And then the reason I ask this is because in Northern Virginia, sometimes we have very competitive markets depending on where, time of year, etc. And clearly they want to be as competitive as possible, and if there are multiple people bidding on the same property, how much can you do so that their application can look even more attractive than, say, somebody who's just starting to get pre-approval?
That's a great question, and that's something that I get queried on a lot, not necessarily from customers, but from the public. Being the president of the Virginia Association of Mortgage Brokers, there's a lot of great perks to it. Sometimes there's some that are not good perks to it. And some of that is taking calls from consumers, complaints about certain issues. And one of, I think, the biggest ones is I was told I was pre-approved, and I really wasn't. We got 3 weeks into the process and something popped up that they should have known. That's very common. And so what a lot of firms do, and you're not supposed to do this, okay, but a lot of firms, what they'll do is really pre-qualify somebody. And that is to speak to them, ask them some general questions about their income, their assets, and their credit score. Hey, is your credit good, excellent? I mean, that's not really telling you what you need to know to actually price the loan out and get it approved. But you've got general parameters. Okay, based on that, you should be approved for X, okay? But there are things that pop up that are asked in an application process, okay, or that could throw that all off kilter. So what I do, and I've always done this, and people call it old school, but it's worked very well for me. I don't remember the last time, matter of fact, I don't know if I've ever had anybody not get the deal, okay? So rather than take information over the phone and get somebody pre-qualified, we go the extra step, not only of receiving certain documentation to verify that, we actually take that, put it in our proprietary system, and actually push the button and run that through Fannie Mae's credit approval system, which is the exact same thing an underwriter's going to do. Okay? So once we get that, it comes back approved eligible. Unless they lose their job or something catastrophic happens that nobody could plan on, we should have a deal without any issues.
Okay. All right. So you actually go the extra mile. You go further than a lot of lenders might go.
Absolutely.
Which actually brings me to my next question: is what's a pre-approval letter, and why is some pre-approval letters close to being worthless?
Yeah, well,
exactly.
That's a great question. It does tie exactly in, so that's great you're asking that question here. But the answer to your question is really a lot of people are pre-qualifying people and putting a pre-approval letter, so they put the word pre-approval on there when they really only pre-qualified somebody. Okay? And that's a big issue because there are questions on application. Been bankrupt in the last 7 years. There are certain things that may not be asked by a real pro in the pre-qualification process, the numbers might look good as far as their income, the debt-to-income ratio, the general categories, but if you're not asking the critical ones that might derail the whole process, then you're in trouble. And so that is totally different. So a pre-approval is, for me, is going through that full process all the way to the point of getting it run through Fannie Mae and getting the credit approval, which is what the underwriter does, versus getting some general questions answered, pre-qualifying, and just putting the word pre-approval.
Got it. Okay, so it sounds as though you have basically the two steps involved here. One is pre-qualifying, which makes sense. The other, the final part of that process becomes the pre-approval. So the pre-qualification is the series of questions that need to be asked. Once those have been answered satisfactorily, then you get to the pre-approval. But in some cases, I think what I'm hearing you say is that some lenders will give a pre-approval letter, but they haven't really asked the searching questions. And
Correct.
So it makes the pre-approval letter really next to worthless because it hasn't gone through
Correct.
the whole process.
That's
Gotcha.
correct.
Okay. In a busy seller's market, what does a buyer risk by waiting till the last minute to start the mortgage application process?
Well, you know, in the market we have right now, where, you know, typically, as you, I'm not telling you anything new here, that the average is about 6 months of inventory. We're down in the two month category now, so it's a severe seller's market, multiple contracts coming up on properties. You have to be able to push the button, write the contract, and adjust or react to the counteroffer. And the only way to really do that is you're pre-approved now. So if you wait till the last minute, and it still happens, believe it or not, but not as much as it used to, but I'll get a call, hey, I've put a contract in on a house. I'd like to get pre-approved. And I'm like, you know, that's kind of, yeah, that's, now, because the listing agent, if they do accept or before they accept, they're gonna call me.
Of course.
And say, hey, and I'm gonna have to say, no, I haven't seen their income, I haven't seen their assets, you're done.
Yeah.
Okay, because the other offer can be accepted.
Right. So that's a very important point that that Bill makes, and of course it does actually pertain to being buyer agent, listing agent, which is where we come in. And absolutely, as a listing agent, if an offer comes in, and let's say multiple offers come in, one of the first things we do to help our sellers is to call each individual buyer's lender and find out exactly where the process is. And so in a situation like this where a buyer has left it to the last minute and a contract and an offer comes through, we call that person's buyer and he'll tell us that he hasn't gone through the pre-qualification process. And that seller may be advised by us not to take the offer, to perhaps take another offer where the buyer has gone further into the process. So it's really important that buyers prepare, just as they would for any other huge transaction in life, you know, have time on their hands and really be able to work things through. That way they're always in a stronger position and they can actually make some decent decisions. So
Real
that's
quick,
absolutely true.
props for Angie. I was kind of throw that out there because she does do this on every transaction, and you'd be surprised the amount of listing agents who don't do it at all. I mean, they'll go through 10 transactions in a row, and I'll never get a call from a listing agent. It's just, I don't understand that process because it's really not representing the seller. So props to Angie and her team. They do that every time, and it's awesome for all sellers.
Thank you, Bill. How does a buyer start the process to take out a home mortgage?
Well, typically for me, I mean, obviously I have the online capability for applications. We have, you know, through email more than online stuff. It's not applications, but it kind of elongates the process. For me, I prefer to do a face-to-face situation for all of your clients, as you're well aware, where I'm doing a mini consultation, I'm answering the questions, I'm identifying those challenges we talked about earlier that might potentially be there. I'm taking the application and you know, at that point, you know, we're ready to go because we're going to go back into the process of the pre-approval and get it right to Fannie Mae and get it done.
So you actually like to sit down with people at the very beginning so that you can really ask them some searching questions, because if they do it online, they could do it online, but you get the information, but there may be more information that you could use. So it actually behooves you, but it actually helps the client to spend that time at the very beginning face to face. And I don't think too many lenders actually do that.
No, actually, that's true, and I actually kind of, you know, I have the moniker the traveling mortgage broker, because I not only go to them, you know, at the beginning of the process to start and identify those challenges, make sure there's, sometimes I'll ask a question and then something else pops up that's oh, this is a separate document you need for that, and you wouldn't know
I
that
wouldn't know that.
online, okay?
Right.
So that's addressed right there on that first day,
Yes.
not 2 weeks into the process, where it can be a challenge and slow down the process further on.
Right.
So going to closing at the end, meeting of an application at the beginning, holding their hand between in the middle,
Yeah,
which is
just
necessary.
makes for a much smoother
Yes.
process. Well, there's another parallel here. When we work with buyers for the first time, we typically ask them we ask to meet with them for 15, 20 minutes, and rather than immediately go out and show houses. And often that will raise an eyebrow, but we let them know that we then can sit down and really get a sense of what they're looking for, what their budget is, what their timeline is, ask us a bunch of questions that will help us. And in fact, that 15 minutes is an investment because it can save them 2, 3, or 4 hours, if not longer. So
Absolutely.
again, lots of good parallels.
Absolutely.
What other documents do people need to prepare for that process? Because I know at the beginning you're asking for some things, but do you end up asking for more things as they get closer to the settlement date?
Well, typically the answer to that is no. Okay. And there is different documentation for self-employed versus salaried people, but you're going to ask for, W-2s, 2 years worth of W-2s, 30 days worth of pay stubs. You're going to ask for 2 months worth of bank statements. So there's certain finite documents that are required as a minimum, right, to get them qualified for their debt to income ratio, their income levels, their asset levels, for the down payment, different things that are involved in that. When that's sent to Fannie Mae, it comes back and says approved eligible, and it may ask us right at that point, right on day one, but you need this and this that nobody anticipated based on the information that we submitted. An underwriter would have certain guidelines potentially for a specific lender because they have different overlays, they call them, so additional things beyond Fannie Mae's requirements. That should be addressed typically within 48 hours of it's being submitted to underwriting, so right at the very beginning. That's typically kind of the documentation phase. Things that are way late in the process should not happen other than updating a bank statement or something like that if it becomes old. But new documentation late in the process should not really occur.
Okay. What about the debt to income ratio? You touched on that. But before we talk about that, let's talk about people who are self-employed. So how are things different for self-employed individuals? You did ask for 2 years of tax returns. Is it any different for somebody who's self-employed?
It is, and that's the big difference is the tax returns. Depending on how much they own in the company, depending on how big the company is, they may ask for a profit and loss statement, a year-to-date type thing. But typically, it's the bank statements. And so, and right or wrong, this is the way it's always been done. The W-2 employee is going to go right to the top line. Your gross income is what's used for calculating your debt-to-income ratio. On a self-employed person, they're going to go all the way down to the bottom line, your adjusted gross income. So they're going to take the number after your very creative accountant has written off every rubber band and paperclip, everything they can think of to help you on the tax side.
Yes.
Okay. But now you're qualifying with a lot less income. So that can be a little bit of an issue.
I see, gotcha. Okay, so it's important for self-employed people to really know that it's a little more stringent perhaps for them at the very beginning. Okay, tell us about debt to income ratio and what factors do you consider to determine a buyer's debt to income ratio? Okay,
so once you establish what the income level is, you're going to interview the customer, find out what loan programs, get that all nailed down, and you're going to actually calculate a payment with everything included, principal, interest, tax insurance, and mortgage insurance if it's required, and the HOA for qualifying purposes, not part of their payment, but for qualifying purposes in our industry, we need to include that as well. You're going to take that total number and you're going to divide that into their gross income, and it's going to give you a ratio, right? And typically they're looking at 28 to 35-ish in that range. It can go higher depending on compensating factors, high credit, different things that might be positive compensating factors. Then they're going to take your what's called secondary debt, and that would be credit card payments, minimum payment required, auto loans, student loans, those type of things that would be outside the mortgage, but they're liabilities. Do not count utilities and different things like that, so it's going to be real loans. Then they're going to take the mortgage payment, and they're going to take the total of all of those together, combine them, and then divide that into your gross income. That's going to give you what's called the total debt to income ratio. That's your whole monthly liabilities into your gross income. And that that actually just changed in last August. Fannie Mae and Freddie Mac goes to about 50%. FHA goes to about 55%. But there's word out right now that the mortgage insurance companies who drive a lot of lending, who actually insure a lot of the loan products, are going to start backing off of the 50% for Fannie and Freddie. They want them to go back to the 45%. When that's going to happen, or if that's going to happen, I don't think it's a good thing, and I don't really kind of understand it because Fannie and Freddie are under conservatorship, just like FHA. They're all managed by the same thing, or all the kind of. So I don't know why they would be pushing them back.
Yes.
But that's kind of word on the street right now. So let's see where that goes.
Okay. All right. Does getting a second opinion from another lender make sense? And does this lower the buyer's credit score?
Well, so the answer to that question is supposedly, I'll use that word supposedly, if you inquire within a 30-day to 40-day window with multiple mortgage lenders, it's not supposed to hit your credit score each time you do an inquiry, each time your credit is accessed. I would not test that myself. I mean, really, when you get down to it, the money's really all the same. It comes off of Wall Street, pretty much. Okay, so what you're looking for, rather than necessarily rate, is, do I trust the fella or gal? Are they answering my questions appropriately? Are they local? That could be, so you're kind of going over the parameters. Now, obviously you're going to ask the rate question, but the rate question may or may not be relevant, because unless you ask on the same day at the same time, it may not matter, because the day later rates may have changed, and so now you're apples and oranges. Okay.
Interesting. Okay.
So it's kind of critical that you got to pay attention. But a second opinion never hurts. I mean, that's you're going to find out typically. If you speak to me and then you speak to somebody else, you're going to see the difference pretty much right away.
Right.
With the service level, we just talked about going to meet them and answering questions, going to settlement, the in-between with the video pieces, which you're aware of that I do, and different things like that. So I'm never weary or scared about a second opinion. So I think it's good for the consumer to at least explore something to make sure that number one is the real person. You never know until you talk to number two.
Absolutely. But as far as rate is concerned, as you pointed out, it varies from day to day and within the same day several times.
That's correct.
So you may get one rate from one lender and then 2 or 3 days later another, but it doesn't mean that they're not necessarily offering the same rate. It just depends on how it fluctuates.
That's correct.
Okay,
On that day, that was the right rate, but if you called me back, I would give the same rate too.
Right, exactly. But then you can be you can be asking questions about the institution, how you feel about the person who would be helping you, and just get a sense of feeling more comfortable.
Absolutely.
So there's that aspect to it.
Well, of course, absolutely.
Yes.
And of course, reviews and different places you can look up. But obviously, if you're working with a great real estate professional like yourself, that they have comfort and trust in already, that should be a heavy weighing factor as well.
As well, absolutely. And trust is very important in all of this. How much does an appraisal cost? Who pays for the appraisal, and who does the appraiser work for? That's
a great question. And people would not be aware of this because it really kind of happened after the big meltdown in 2008 with the mortgage and economic situation that happened. But the answer to the question is, appraisals typically, they're going to be $480, $520, so let's call it $500. Okay, that's going to be a good round number. $480 to $520. Doesn't matter what the price of the house is that they're thinking. Does it matter the size? Condos versus single families? It can. Okay. Typically, when you get into the $1 million level, 800,000, and I'll say 800,000 up. Now you're looking at tougher to find comparables. You might find that there haven't been enough sales in the last 6 months in that area because there's not as much transiency in that level versus the 200,000 first-time home buyer, which has a lot of turnover. Yeah. So those can cost more, and those are done on a case-by-case basis because they're also geographic. So something down in Fredericksburg, 800,000, now you're going to have to find the pool of appraisers down there is smaller. So the price to get somebody to go out there, so they're busier. So the price to get somebody out there might be a little more. And the fact that it's on a higher price range and you have extra work involved, because there's also usually additional comparables required in the appraisal. Now you can't do the 3 or 4 normal. You might have to do 6 or 7 comparables, which means more travel time too. So it's a little more expensive for the upper levels. Okay. The appraiser, typically, it used to be that I would call the appraiser, and I was using people 30 years, great people, just great people, never had a question ever. Because of the meltdown, they're worried about transparency, and issues with I might be asking the appraiser for an extra little something out of a price that was tough to work on. So they kind of got away from that. So now what they have is a totally new industry, actually. It's a cottage industry. Appraisal management companies, AMCs are called. And so they're set up, they're not typically owned by the bank. I have no idea who they are, other than the fact I have 3 to choose from each lender typically. And I assign it to Appraisal Management Company A, is the name of the company, okay? They then send that request out to their database of appraisers who then, somebody will say, I'll take that order, okay? So I have no clue who it is. As a matter of fact, I'm not even allowed to speak to them directly. That's illegal to do that. That's kind of how it's changed a little bit.
Okay, and who does the appraiser work for?
He works, actually he works for the appraisal management company.
But the lender, presumably.
No, he doesn't work for the lender. This appraisal management company is totally a third-party situation, and he works for them, okay? He's preparing the appraisal for the lender.
The lender.
Okay, so the lender's name is going to be on it, but he's not working for the lender because that's part of why this was brought into play. Was there lenders were actually on their own loans were saying, hey, give me a higher value because it's not working, which is crazy because that's, their collateral, which is the home, they're taking an extreme risk on it by getting a fake number and then lending on it. So that was part of what's happening.
So the buyer is the one who pays for the appraisal anywhere between $450 and $520.
Right.
The lender then goes through one of these AMCs, did you say?
Yep.
And then the appraiser basically works for the AMC, but really reports back to the lender, and even though the buyer is paying for everything. In other words, the point I'm trying to make is even though the buyer is actually the one who's paying, the buyer is not the one who is the direct customer.
Correct. As a matter of fact, most people don't know this. The buyer doesn't own that appraisal, even though they pay for it. The owner of that appraisal is the lender, okay? And so if you want certain things to be done, it's hard to take it to a different company, okay? Because it's in that lender's name.
It's in that lender's
name. Yeah, because it's done for them. So it's not really the property of the borrower, even though they pay for it. Which I always thought was kind of strange, but that's how it works.
Yeah. What do buyers need to understand about appraisals and appraisers?
I think
general, but they may not be aware of.
I think the one big important thing that people get confused on a regular basis, matter of fact, I just recently created a video about this to kind of delineate the differences. A lot of people think appraisers are home inspectors. They're not. And they really, although FHA appraisers are close to it, FHA has changed the standards for quite a few years now. Matter of fact, some appraisers have dropped out doing FHA appraisals because they are requiring them to almost be at the level of a home inspector. Not quite, but way more than a conventional type loan. But they get confused. That's not what they're there for. They're there just kind of, as long as the roof's not falling in and major things aren't unsatisfactory, they're there just to present an opinion of value. That's really all it is, based on other properties in the area. And they'll make adjustment for, the one they're comparing to has a basement finish and this one doesn't. So they're going to make adjustments all through the appraisal. There's probably about 15 or 20 different adjustments that they're going to make to compare them equally to get a value. So that's kind of how, but I think the biggest thing is they get confused with home inspectors.
Right. Yeah, and if a house doesn't appraise, can a buyer appeal the appraisal?
You can. It's not very often that the appeal goes through, percentage-wise. But I have done that. Most people don't know you can do that actually. But I have to go through the AMC and appeal, and then they go back to the appraiser. I cannot talk directly to the appraiser. Right? Now, in order to do that, you have to have a great real estate professional like yourself to help out with additional comparables that might be able to use that the appraiser didn't see or didn't use. Okay, yes. So you'd have to have supporting data to actually do that. But it can happen.
It can happen.
Yes.
Right. So buyers can appeal an appraisal. Does it make sense to get an appraisal if a buyer is paying all cash?
If I was the buyer, I would. It's not required, obviously, it's a cash transaction, but that wouldn't make sense to me to go into any investment, whether that's my own personal residence or a true investment property, not knowing if I'm overpaying or Those type of appraisals are different though, actually, in a lot of cases. And appraisers, a good appraiser should ask you that question. So if you're doing something like a cash buy, or if you're doing something just for a couple getting divorced and they just want to know the value so they can work through their divorce paperwork, those are typically not Fannie Mae, Freddie Mac standard appraisals, all right? So, and there's a little different format to them, all right? The cost is about the same, so sometimes a little cheaper, but they're about the same, but they're different appraisals, so.
Okay, so you would suggest having an appraisal done nonetheless? Because some people may be paying cash, but then at some point in the not too distant future, they may want to refi and take some money out. And so having a good sense of how much the house is worth is worth.
Or somebody is flipping a property. You know, it's holding it for 30 days, 60 days, 90 days, just to kind of go in there, do some cosmetic things, nothing typically structural, and then flip it back on the market. So you want to know, what's the value, because if you're intending to do that, you've better be way below that appraisal value, all right? So that when you do your improvements, you've got some room in there at the end. There's a profit. Exactly.
Yes. Now, as we said, the operating table, the patient being the transaction, how do you work with a title attorney, a title agent, a buyer agent, a listing agent? And we've kind of alluded to this a little bit before.
Yeah.
What would you say your relationship is with the title agent, and how does that, what does that involve?
Well, for us, it's done in phases, right? Typically near the beginning and near the end for a title agent. Regulatory-wise, we're required to put out a loan estimate, used to be called a good faith estimate years ago, within 3 business days of an application. And so in order for us to put something out that's accurate, we always ask the settlement company right away when we get a contract immediately to prepare a preliminary CD or LE. We actually ask for a CD, and they're going to go and actually take the sales price and loan amount, and they're going to calculate all the fees for the county, the fees for the state, the different things that a settlement company is in charge of. Okay, it's not part of the lender.
And CD stands for closing document.
Right, closing disclosure, and that's kind of what used to be called the HUD-1 settlement sheet. And so our loan estimate goes out accurately. So that's the first part of what they do. Then after that, we kind of make sure that they understand who is going to be the owners on the property, because it's not uncommon for a husband and wife to be buying a home and one to be on the note and the deed, the note being the financial instrument for paying the loan back, and only the other party being on just the ownership side. It might be bad credit, no income, some whatever issues.
Yes.
So they need to know that so that they prepare the title work, which is going to be what's going to be handed to the lender, with the insurance, everything else that they do. Right? So there's a little, towards the beginning, not the very beginning, and then at the very end, we're working on the closing disclosure to make sure all the numbers are correct. Anything that may have transpired through negotiation during the process after the very beginning that's come up with additional seller concessions or different things that they may not be aware of, we need to be communicating well in advance of settlement to make sure those get corrected so we get all the CD corrected. Yeah.
So you have a lot of contact periodically throughout that period of time with the title agency to make sure that the numbers and everything's being taken care of. And of course with the listing agent, presumably your relationship might be with that initial call. The listing agent may call you and say, this buyer, your borrower, I'd like to know how far they are in the process. They may check in with you again as you get closer and closer to closing. Less so probably with the buyer agent, or the buyer agent may be also speaking to you just to see how ready the buyer is to be able to sign an offer.
You'd be surprised. I think, I don't think I know, because I've looked at various reports over the years, and it's probably never going to change. The answer to the biggest complaint from the listing side is no communication. It's a black hole. I don't know what's going on. Right? It's almost every transaction. Is that a good thing? No. For a lot of different reasons. It's good for them to feel comfortable so they can inform the sellers, but it also limits calls to you if they're very aware of what's going on, so they don't have to call you. Okay, so it's going to help you out in the process as well. I mean, really to take care of that, the answer is I've got videos through the process, 7 or 8 of them, that go out to both so that everybody knows exactly the appraisals or the appraisals in the different stages, so everybody's very well what's going on. It's an awesome thing to be involved at that level.
Yes.
Some people want to know it, don't want to know, but you know what? They have the access to it if they want to know.
If they want to know it, so you keep them very well informed. Okay, that's great.
The buyer's agent is obviously, it's a very close relationship to that. I mean, I'm going to let any challenges that come up, or just maybe even sometimes a weekly update. Nothing's happened. Just say, hey, just want to give you a call. Nothing's really happening. Here's what we're waiting on. Expect that to come in next Tuesday. So the buyer obviously is a agent is a lot closer relationship than the listing side, but I always kind of make it a point to involve the listing agent so that they understand what's going on.
So everybody knows what's happening.
It's the operating table.
Yeah, it is. It is.
Exactly.
It is, you know?
Exactly.
Exactly. What do you particularly do to safeguard your buyers that other lenders may not be doing? And we touched upon a little bit of this in terms of your face-to-face at the very beginning. Anything else that you might?
Well, it hasn't happened very recently. It does still happen, but there was a time on the run-up to the big meltdown where you could get approved for the most ridiculous debt-to-income ratios, like 85% of your net take-home could be going towards all your debt. Now, how you afford gas and food and clothes, I don't, but you could get approved. There was times during that period, and it still happens, it's a more rare now, but it's my fiduciary responsibility not to just make money and do loans, okay, is to help advise people. And hey, look, here's the deal. I can probably get you approved, but you are going to be really, really tight, okay? Because I know you have some additional expenses beyond that aren't counted in your debt-to-income ratio in general, but you're doing special disbursements to special investment things. So it's going to be really, really tight. You might want to think about maybe coming down on your sales price a little bit. Not tremendously, but something a little bit, because I think you're going to be a little bit, and that's just part of the relationship and doing the right thing.
Right.
Okay, so that happened a lot back then. Okay, because people were just, as we know, because foreclosures and all things that came up as a result of it, yes, were doing the wrong thing because they could get approved. Yes. So there's beyond that, you need to be the pre-approval process, doing that properly. That's very critical. Mm-hmm. So I think we've touched on a lot of things.
Yeah, and coming to settlement and making sure that if there's an issue at the very end, at the closing table, that you can take care of it there and then, so that there's no hiccup whatsoever.
Absolutely.
So lots of safeguards there. Okay. What are some traps that buyers fall into, and what should a buyer never do?
Well, let's do the never do first. Okay. The never do is quit your job. Believe it or not, during the process, more than once, okay, I've had people quit their jobs. Now they have another job lined up, but that gap of 2 weeks before they go to the next job, you can't go to closing with no income, because they're going to call literally right before settlement, someday the same day or the day before, to verify you're still employed. If they say no one longer works here, we got a problem, okay? Because it's not based on future income, it's your income at settlement, okay? Credit. Don't go out. I've had people go out and fulfill their whole house full of furniture requirements. Even though it's only 2 people, a 5-bedroom house, they've filled every bedroom, everything, and they don't qualify anymore, believe it or not. So don't go out and get additional credit. Don't go out and lose your job, quit your job. Can't lose. I mean, that's something you don't control. Don't quit your job.
Yes.
Those are 2 big ones. And the other question was the first part?
Traps that buyers fall into.
This is one of the biggest ones. Normally you don't run into a lot of traps, but I find this predominantly with younger borrowers or first-time home buyers, okay? Up into the mid-30-ish level. It's based on things they've heard from Uncle Joe or things that they've made assumptions on themselves. And it's very common for people to come to me and say, hey, here's my income, and I ask the debt question to calculate, and they say, I don't have any debt. Oh, okay, do you have credit? Well, no. Or sometimes, yeah, I have 1 credit card. You have to have a minimum credit to get a score. So that could be a challenge or an issue. But a lot of folks, what they'll do is they'll pay their debt off thinking, hey, having no debt's the ultimate best position. Well, it's good to have no debt, but if you have no asset base to put a big down payment down, then you can't do the transaction. In all reality, if they had kept that debt and kept all the money in the bank, they'd have been in a much better position because they still could have qualified carrying the debt. So and that's just an intuitive thing people do. Yes. And that comes into the 6 months in advance. 6 months in advance. Okay, make sure you have this much in reserves.
Right, right. And also people sometimes wonder, they pay their debts off immediately, they don't really have any credit cards, and then they wonder why their credit is actually a bit lower than they would have expected. Yeah. Their credit is good, but it's not super excellent. Mm-hmm. And it's not that they wouldn't necessarily have excellent credit, it's just there aren't enough channels open that are using on a regular basis to be able to test them. That's correct. To give them a higher credit.
That's correct. Yeah.
So that's also counterintuitive.
The actual balance is funny because, again, counterintuitive. You think, hey, I only have 1 card, I only use it every once in a while, that's the best thing. That's the best thing. You literally want to have the ultimate is a mortgage or rental history, an auto loan, and 3 credit cards. Wow. Okay, that's when the credit model looks at your score, That's what it's looking for, all right?
Interesting.
So yes, only have one credit card, it's only been open 12 months, that can be an issue.
And this question has just occurred to me, so see how you think about what you think about this. But let's say somebody is wanting to buy a house and they're realizing how expensive things are. They've got closing costs, they've got this, that, and the other. And let's say that Uncle Joe decides to give them a gift. Sort of during this process, can that easily be handled?
Yes, that's pretty simple.
Okay.
Certain loan programs require a minimum amount of down payment or investment from the borrower. But a standard gift, if they've got that criteria, is a 8.5 by 11 gift letter. They fill it out, and then of course you have to document it properly, which is show me a statement or the ability for the donor to give the gift. So one bank statement usually, or a letter from the bank saying, some people are sensitive about giving the bank statement, or a letter from the bank saying that they have the assets available on account blank, blank, blank. Mm-hmm. And then you have the check that's actually in transit, and then a deposit slip. So the source with the ability to donate in transit would be the check, copy of the check, and then a copy of the deposit slip at the time. Eventually you're going to need to show that in a bank statement before you get to final approval that it's actually cleared to the bank.
And just for clarification, what we're really talking about is once the buyer's gone out, put an offer on a house, hopefully with a good buyer agent, had that ratified, so the buyer and the seller are absolutely in agreement, and that's when the clock starts to tick and you start to do all the extra work. And so it's usually, 30 days, 45 days, depending on the type of loan. And that's, I'll come back to you, that's when Bill was saying you don't go out and change jobs while you're being monitored throughout this 30 or 45 day period, because it can become a problem. That's when you don't go out and fill your new house with furniture before you bought it, because that can become a problem. So that critical time period of 30 to 45 days is when the buyer needs to sit tight and be patient and not go out and take out lines of credit or change jobs.
Correct.
So going back to that question, would you say 30 days is a good time period
30 days is pretty
to get the
standard.
loan in place to close?
Yeah, 30 days is pretty standard. I mean, it used to be not that long ago that 45 days was a standard. There were lots of banks, and this was another negative to the banks at the time, were 60 days out. Well, not many sellers are going to wait 60 days to get the settlement because they want their money now. They're buying another home, they got to move on. Yes. But it was 45 days. Now over time, the regulatory thing, again, this is the broker advantage of being more flexible and quicker to the market, have taken care of some shortcuts, different technology to cut that 45 down to 30 days. Just literally recently did one in 12 days. Okay, perfect file, perfect client, everything was there, nothing was extremely vanilla, done. That's the exception, not the rule. But 30 days should be plenty of time for most lenders to get the process completed.
And then of course this one is how can buyers best prepare for taking out the mortgage, and we've already talked about that. That's 6 months, just to recap very quickly. If you can, 6 months ahead of time, reach out to your lender, reach out to a good buyer agent and start getting the process in place. And certainly as far as the different credit lines that they're going to be pulling from, not paying everything down, just to be fully informed and no surprises. Anything else you wanted to add?
No, I think you pretty much covered everything.
Good. Okay, excellent. Well, thank you very much. Again, Bill Burnett from Homestead Mortgage, and I hope you'll join us next time. Thanks, everyone.